Short selling or shorting is a trading strategy in the stock market, where an investor borrows shares of a stock they do not own, sells them at the current market price, and then aims to buy them back later at a lower price to return the shares to the lender. The goal is to profit from a decline in the stock's price. How short selling works. 1. Borrowing shares. The investor borrows shares of a stock from a brokerage or other investors. 2. Selling the shares. The borrowed shares are sold on the open market at the current market price. 3. Waiting for price to drop. The investor hopes the price of the stock will decrease over time. 4. Buying back. Covering. Once the stock price drops, the investor buys back the same number of shares at the lower price. 5. Returning the shares. The shares are returned to the lender, and the difference between the selling price and the buying price, minus any fees or interest, is the profit. Example of short selling. You borrow 100 shares of a company, say Company XYZ, when the price is $50 per share. You sell these 100 shares for $50 each, receiving $5,000. Later, the stock price drops to $30 per share. You buy back 100 shares at $30 each, costing you $3,000. You return the 100 shares to the lender, and you pocket the difference. $5,000 initial sale, $3,000 buying back equals $2,000 profit. Key points. Profit. You make money if the stock price decreases, as you can buy it back at a lower price. Risk. Short selling comes unlimited risk because there's no cap on how high the stock price can rise. If the price goes up instead of down, you may face significant losses. Margin requirements. Since short selling involves borrowing shares, brokers require the investor to maintain a margin account, and they may demand additional collateral if the stock price rises significantly. Why do people short sell? 1. Speculation. Investors may short sell if they believe a stock is overvalued and expect its price to drop. 2. Hedging. Investors use short selling to hedge against potential losses in other investments, e.g., shorting stocks as a protection for other holdings. Risks of short selling. Unlimited losses. Unlike buying stocks, where the loss is limited to the amount invested, in short selling, losses can be infinite since the stock price can theoretically rise indefinitely. Short squeeze. If a stock is heavily shorted and its price unexpectedly rises, investors may be forced to buy back shares quickly to cover their positions, leading to a sharp price increase. Legal considerations. Short selling is legal in most markets, but it is regulated to prevent market manipulation and excessive volatility. Some restrictions may be placed during times of extreme market turmoil, e.g., banning short sales in certain stocks. In short, short selling is a strategy to profit from declining stock prices, but it comes with significant risks and requires careful management.